welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think for Donald Trump picking Scott Bessent for Treasury Secretary, this is the exact pick the market wanted. Someone with significant investment experience, especially in the macro environment. If we look at the Trump policies on trade, on tariff, having someone who understands the knock-on effect of that and can help position the United States to mitigate that, especially in other parts of his agenda. I'm sure we'll talk about tax cuts. I'm sure we'll talk about deregulation, but this is who the market wanted.
I really don't think it's anything to worry about. Think about several years ago, we had this discussion about 20,000. It went lower. Then we had this discussion earlier this year at 73,000. And now we're having this discussion again at 100,000. So we look at this as a phenomenal opportunity to dollar cost average your way in.
I think, what we've seen for the past couple of years, this is nothing new. Department stores are losing traffic. They're losing share. Macy's is no exception. Really, you've looked at brands and retailers that have grown, double digits to be conservative since pre-COVID, and Macy's really just hasn't grown, and they continue to comp down.
We got 1 hour to go until the market close. So let's take a look at the major averages here, Josh. We got some records to talk about today. One of them is for the Dow, which is up 383 points right now. 44,680 is where we stand at the moment. That is a record. The S&P 500 not quite there, but it's up about 1/5 of 1%. The Nasdaq up 1/5 of 1% as well. Where we are seeing other records, small caps, the Russell 2000 outperforming again today, up 2%, and equal weight up 9%, or 0.9 of 1% for the S&P 500. And this is on that sort of reassurance that the market seems to be feeling over that pick of Scott Bessent.
Yeah, it's interesting. So Trump has now really picked his core big cabinet positions. Yeah. You were waiting for who he would name for Treasury Secretary. You got Scott Bessent, who's an impressive resume and background. Our buddy Peter Bukvar telling his clients this morning, it's a great resume in Peter's view. Bessent, if he was confirmed, would have a ton on his plate. I mean, just think of taxes, deficit, dollar, tariffs, but I think you get the pick, and you also just generally just remove another level of uncertainty here for investors.
Right, and we should also point out, unlike some of the other nominations for various cabinet positions, Bessent doesn't seem to have any significant opposition. So, even though he has not yet been confirmed, the assumption on the part of the market and on the part of those in D.C. is that he's going to get confirmed. So that's just something to note there. In terms of what else we're watching in today's session, on the group side, we've got energy heading lower along with oil prices. We're going to get to that a little bit later. Consumer discretionary rallying the most today, along with real estate and materials. So kind of a mix of interest rate sensitive and cyclical sectors. We've seen that kind of mix lately, and it's been kind of interesting to watch.
All right, let's get more on this market, shall we, Julie? For more, let's look on the latest market moves. Let's now welcome in Venu Krishna, Barclays head of U.S. Equity Strategy. Venu, it's good to see you. So you raise your S&P 500 target for 2025 to 6,600. How come? Walk us through the drivers there.
Well, I think the core reasoning is that from a macro standpoint, we are very constructive on the market on two fronts. One, the virtuous cycle between income, employment, and consumption is extremely strong, and consumer balance sheets are in great shape. And second is the overall fact that the economy is doing quite well, right? And especially if you look at the technology sector, it is humming. So when you put those things together at the core, we remain quite constructive about next year.
And Venu, it's interesting that you mentioned technology, right? Because there's been this whole narrative about broadening out of at least stock returns for what we've seen in the market. And indeed, that's been borne out by the Russell 2000 doing better, the S&P equal weight doing better. But you also look at earnings growth for tech, and you say maybe the market is underestimating the amount of tech earnings per share growth we're going to continue to see. And in fact, you had a chart looking at the large cap tech versus the other companies in the S&P 500.
Yeah, I mean, I agree with you 100%. I think what is happening right now in our perspective, and this is what we have said for quite some time now, that the market is on a consistent basis underestimating the earnings power of tech, especially big tech. At the same time, it is systematically overestimating the earnings power of the rest of S&P outside of tech, right? And so this quarter is a great example of that. The expectation going into this quarter was for big tech to have flat earnings. Have earnings up 19% year over year, but their revisions were kind of flat. For the rest of S&P, the numbers are actually marked down 2% going into earnings. What happened when we're pretty much done with earnings? Instead of 19%, big tech as a group delivers 31% of earnings growth. And the rest of S&P, it moves in the right direction, but incrementally. So instead of minus 2%, it's plus 2%. So the point is the rate at which tech earnings are expected to decelerate is going at a slower pace than what the market expects. At the same time, the rate at which the market expects the rest of S&P's earnings go to accelerate is also much slower. So this so-called convergence, which the market was factoring in to happen in Q1 of next year, has got pushed back to Q1 of 26.
So what does that then imply about the rate of returns, right? Because accompanying that narrative about convergence has been the narrative that the rally needs to broaden in order to continue.
Yeah.
But it sounds like from what you're saying, it doesn't necessarily.
It will converge, but at a much slower pace. So directionally, I think the good news is we are going in that right direction. And so for tech, if you look at the problem is, or the challenge is, that their comps are very tough. So Q3, Q4, they were posting 60% plus growth. So that's what you're looking at now. But for the rest of S&P, they bottomed 2 quarters after big tech. So their comps actually are easier. So for them to meet the numbers are reasonable, right? So, but the scale in general doesn't change. I think we expect what you saw this year to broadly continue into next year. In other words, the fulcrum of this market will remain big tech, and the rest of the market will continue moving in that direction, but it will disappoint the market in terms of growth. For example, the consensus expects the rest of S&P's earnings to grow 11% next year. We think it's going to be 3.5%.
Wow, that's a big disappointment.
Then let me ask you, so if the economy is resilient and inflation's moderated and earnings growth looks decent, what worries you? What are the risks we need to think about?
Well, there's risks are different. Let me first start with the earnings, right? So one of the things we have seen is we have always said that when inflation is moderating, we've said, be careful what you wish for. Because a lot of companies in the US benefited with the extraordinary ability to exercise pricing power after COVID. Now that has run its course. So now, as inflation is coming down, their ability to hold on to those prices and hence margins is incrementally more challenged. So this you see in the staple space and the discretionary space. So some of them are able to hang on to it, not everybody. But in terms of risks, there are a number of risks. But the key one, I think, is related to rates right now, right? So far, the equity market has looked past the pretty sharp move in the nominal 10-year rates. And I would argue rightfully so, because to your point, we have good economic growth, unemployment is generally low, wages are increasing at a faster rate than inflation, the Fed is actually cutting rates rather than raising rates. So everything is lined up well for equities and for earnings generally. But the problem is once you start going above 4.5, and when you start getting to the threshold of roughly 5%, at least empirically based on what we have looked at, the negative correlation between rising rates and equities kicks in, mainly because the concerns then move towards inflation. And right now, it's not just inflation, the concern that deficits, the scale of it. We are running 7% budget deficits at a time when unemployment is low and economic growth is extremely robust. So it's not supposed to happen, right? And so, I think it's contained for right now, and equities are hanging in there. That's something you want to watch on, which is, what happens to inflation? If, for example, the policy trigger, do the pro-growth policies work? But by working, they also trigger inflation.
Well, you're going, we started off the show talking about Trump, and he's kind of, he's named his core cabinet positions. There's a lot of cross currents there into taxes and deregulation, but also tariffs. I'm curious, just as a strategist, you must get a lot of questions from clients about this. What are you telling them? How do you navigate that?
All the time. Now, in all fairness, it is something which is almost practically next to impossible to model because of the uncertainty of the combinations and not knowing What is going to be the magnitude? What is going to be the timing? Is it a negotiating tool? Are they dead serious about it? How quickly do they move? And all that, right? But I think what you can start doing is putting the pieces together and say, what does each one of them say? So for example, tariffs is a very important issue on which on the campaign, they talked about 60% on China and 10% across the board, rest of the world, right? If that happens, our estimates suggest that the hit to S&P earnings are going to be more than 5%, in that range. Not excruciatingly bad, but reasonably bad, right? On the other hand, if it is more of a negotiating position and you end up 50% of that, not the whole thing, it's going to be about 2%, practically insignificant in the big scheme of things. But I think what this still doesn't address is what I call the second order effects. And those second order effects are the impact of tariffs and of tighter immigration on inflation, on economic growth. So for example, our economists think that if they go ahead full steam with that 60%, 10% combination, then the upwards impact on inflation in year one can be close to 100 basis points, basically 90 basis points. And the downward impact on US economic growth is going to be negative 1.4%. That's our economists' view, right? Now, people can argue whether that happens or not, but those are the kind of issues we're looking at, and that is quite significant. Similarly, if the full extent of the tax policies are actually implemented, then the deficit situation is going to go a lot worse, not better, right? So I think ultimately, I do feel that this is a pro-growth government, which is going to be extremely market-friendly and good for the animal spirits, good for corporate activities, good for investment. But at the same time, you need to find out what the corresponding impact is. They have to be trade-offs. If you're fiscally expansionary, then you need to figure out a way in which you cut your expenses, right? So at some point, you've got to find a balance. And I think the market seems reasonably optimistic. But I would hazard to say that the focus thus far has been a lot of unbridled enthusiasm. And that's why our outlook, we've said it should be bridled enthusiasm, because we are tending to focus more and more on the positives. But I think it's also worth taking a look at what the other side of the token are, and then take into consideration, even though, to your question, it is not that easy to pin it down exactly.
Well, I think the only thing that will pin it down is time, which will
Yes.
help us figure it out. Venu, thank you so much for
You're
coming
welcome.
in. Really great to get your perspective and your forecast. Well, coming up, could a new California EV credit exclude Tesla from its proposal? We'll discuss on the other side. Much more market domination still to come. Now time for some of today's top trending tickers. You can scan the QR code below to check out the best, worst, most trafficked stocks of the session on Yahoo Finance's trending tickers page. First up, got to look at MicroStrategy. Those shares under pressure. The company purchasing another 55,000 Bitcoins last week for $5.4 billion. But the shares are probably under pressure because Bitcoin is under pressure. When you have that much Bitcoin, you know, your fortunes are kind of tied to it here. And we also did, by the way, get a price target increase this morning from Mark Palmer over at Benchmark. And this is what he had to say on MicroStrategy's premium in an upcoming episode of Yahoo Finance's Opening Bid.
So, yes, we see that shares of MicroStrategy are trading at something close to 3 times net asset value. I would argue that based on the company's ability to continue to tap the U.S. capital markets, take the proceeds and buy Bitcoin on a repeated basis, that premium is justified.
And he's one of the folks who's remained a staunch bull on the stock, but not everybody is there.
Yeah, as of November 24th, so now MicroStrategy holds nearly 387,000 Bitcoin. Of course, Michael Saylor started buying Bitcoin back in 2020, refers to MicroStrategy as what calls it, the Bitcoin Treasury company, I think is how he puts it. What's amazing, the stock has been, obviously, we've talked about this, a rocket ship this year. I think it's up 500%. On the street, though, love this name, 8 buys, no holds,
I mean,
no
you know,
sells.
and Palmer talks about the different ways that people, value this company. That if you value it just on the base of its Bitcoin holdings, the price at which it acquired it, and the stock price, it's trading at a huge premium. That's what he was referring to. The company is encouraging people to value it on what Michael Saylor calls the yield, which is a different way of measuring it, and one that Palmer says makes more sense and makes it look more reasonable.
All right.
We'll see.
We move on. Shares of Rivian surging after the EV maker and Tesla reach a conditional settlement. This agreement would settle Tesla's 2020 lawsuit accusing Rivian of poaching employees to steal electric vehicle trade secrets. So this one certainly made a lot of headlines. Tesla, remember, said workers were caught misappropriating core technology. Rivian has denied wrongdoing. Doesn't sound, Julie, like we have specifics about the agreement, but Elon Musk company did tell a judge, listen, we expect to seek dismissal of the case by December 24th, is what they're saying.
Yeah, and the other thing that's clear is that, for Rivian investors, they look at any sort of little piece of good news as a reason to bid up the stock, right? The stock has been battered this year. It's down more than 50%. 18% of the float is shorted. So a lot of people think that the stock's going to continue to go down, and you get a short squeeze on days like this. I know I'm a broken record, man.
No, listen, important information people need to hear.
It's definitely what you see sometimes. So, when you see a pop like this, it's also linked to some of those technical factors.
For sure.
Yeah.
All right, what? Let's stick with the EV space, because California, my home state, Governor Newsom challenging Trump's threat to eliminate the federal tax credit for EVs. Yahoo Finance's Prosper Morning joins us now with the very latest. Governor Newsom, what's the plan?
Your home state.
That's right.
News. So, earlier today talked about how if Trump gets rid of the EV tax credit, they would institute their own EV tax credit which they had before for $7,500, which was, so they restarted an old program that went away. The big reporting here is Bloomberg dug a little deeper, and they found out that Newsom would potentially sunset Tesla from any of these tax credits, basically using a market size approach, which isn't actually that new, because the past federal tax credit had that if you sold over 200,000 EVs, your tax rate would sort of window out until it goes to zero. So not unheard of, but it seems to me kind of nakedly going after Elon Musk. I say which will those two have gone after each other since the pandemic. So I think that there's a little bit of a political kind of play here, but it's not unheard of to actually exclude some companies from getting the tax credit.
Well, and not just now going up against Elon Musk, but going up against Donald Trump, and sort of intensifying as well the idea of California as sort of an island in some policy ways, right?
Yeah, I mean, the biggest thing is the emissions standards that they're going to be battling out, because Trump wants to, or the transition team wants to lower that effect, and I think by 2026 or 2030. The thing with the tax credit stuff is California, Washington State has a $9,000 tax credit. So it's not unheard of for these states to have really, really generous tax credits. The question is, can they afford it? The federal government has way more firepower.
That's a point I was reading, was some of these reports were highlighting that point. The budget shortfall could kind of complicate California's efforts here.
Right, and for instance, Washington, they had to stop the credits in September because they had reached the max. So you're absolutely right. How far can they go without the federal tax credit? That's a big question in California. I mean, they have their issues too with shortcomings with their budgets.
That's also why if you go to buy an electric car, they usually tell you to hurry up. So that before
Get in now, kind of
before
feeling?
the incentives end. Exactly. Thanks, Pross. Appreciate it. Another trending ticker that we are watching closely, Cassava Sciences plunging. That company's Alzheimer's drug failing its clinical trial. Yahoo Finance's Anjali Kamlani joining us now with the latest. Not just plunging. I mean, 84% is an exceptional move by any measure.
Collapsing, crumbling.
Yeah. What was at stake here? Why are we seeing such a decline?
So what happened is Cassava just told us today that their Alzheimer's drug, which was in late stage trial, just failed to meet the primary endpoints, which was supposed to be slowing cognitive decline. That's something that we've seen as a primary endpoint in clinical trials for Alzheimer's drugs, including Biogen as well as Eli Lilly. Now, Cassava failed to do that. They also have, I mean, this is not just a single shot decline. This is a story that has built up over the past couple of years. In 2021, they really started gaining steam because of the promise of the drug in an open label trial, meaning that every participant knew that they were taking the drug, and that's not the gold standard for clinical trials. And so there was a lot of criticism surrounding that. You can see on the chart, going back about 10 years, that it has had quite a rough ride. And that is the reason behind that is because they initially started off doing the steps. And these are just the top line data. We have to see exactly what happened, and they're going to be analyzing the data and telling us, in the near future what happens, but just a complete failure on the part of this drug. So that's why it's down 84% in an entire day.
And the company doesn't have any other products, right?
No, this is it.
This is it. No, it's a pre-revenue company, so to speak.
Yes.
All right, well, that tells you what's going on there. Thanks so much, Anj. Appreciate it. Well, Bitcoin's blistering post-election rally is stalling, the cryptocurrency backing away from that milestone of 100,000, at least for now. Explosive Options technical analyst Bob Lang joining us with more on what could get Bitcoin to that record level. Or maybe it won't be there in the short term. I don't know, Bob, but we kept talking about it. Maybe we talked it out of it or something. What's going on here? Was it just sort of over-anticipated that it was imminent?
Well, it's interesting, Julie, about the hype from the talk of Bitcoin of the past couple of months. I remember when we were on last time in October, I think Bitcoin is up about 50% since that beginning of October, which is quite a substantial move here. It's pulled back a little bit here, about 4 or 5% from that $100,000 mark, roughly 100,000. That's a huge wall up there. That's increasingly going to push sellers to hit the sell button as we push through that number. But I do think that people like Michael Saylor, who runs MicroStrategy, I think they're onto something here. I think that certainly the investing public is looking for something to grab onto, and the momentum from this Bitcoin is just incredible. And if we could make a run much further than most people expect. I wanted to say that just a couple of days ago that Michael Saylor said that he thought that Bitcoin over the next 10 years compounded 29% a year is going to get it up to about 13 million per Bitcoin. That's maybe a bit of a stretch, but that's far off. But maybe he's onto something.
So it sounds like, Bob, just to put a fine point on it, because you've been trading and studying these markets for a long time. Are you saying, Bob, in the short term, you do think maybe we take a breather here before then moving higher?
Yeah, I agree with that, Josh, and I think a little bit of a pullback. They call it a backing and filling of some gaps and so forth in the chart. It's going to be constructive and healthful for Bitcoin and for Bitcoin investors. But look, the momentum is very, very strong, and there's a lot of people, Josh, on the sidelines who are waiting for an opportunity to get in to Bitcoin and other cryptocurrencies. And this next pullback, whatever the size may be, it could be 5%, 10%, could be that one opportunity for people to get in. Look, let's face it, people who are not in Bitcoin right now, they're suffering from FOMO, fear of missing out right now. And I think if that FOMO gets larger and larger for people, they start getting anxious and wanting to get in on any dip. So the dip buyers have been present there for Bitcoin over the past couple of months. So looking for a much larger dip here might be a good opportunity for people to get in.
Bob, there was also the introduction of options on the ETFs that happened last week. As somebody who specializes in options and watches that market closely, what kind of activity did you see, and what does it tell us, if anything, about where Bitcoin could be going next?
Well, the options market, Julie, offers a really great opportunity for people to get involved with Bitcoin and not having to have that kind of money available to invest, right? It wasn't but 10 years ago, I think Bitcoin was probably about $5. Now it's up again near $95,000. So using options gives you an opportunity to leverage up and define your risk, and in putting capital out there to take advantage of a momentum run that Bitcoin has been on and may continue to be on into the future. So I think the options market, about 7-8 years ago, Julie, we had the introduction of Bitcoin futures, and that was really the point where the investing public became very serious and took Bitcoin very serious about investing and trading in Bitcoin. The Bitcoin futures market is gotten very, very large now. I think the same thing is going to happen with the options market for ETFs and for Bitcoin. There's a whole herd of ETFs out there now. BITI, which was introduced last week by BlackRock. I think they had some record number last week of $513 million worth of inflows into that ETF, and the options market is going to take advantage of that as well too. We're seeing a lot of flows into calls, selling puts, that sort of thing. So I do think that the hype seems to be out of control here, but I do think that there is some good story here for some more upside in Bitcoin.
Bob, always good to see you and have you on the show. Thanks for joining us.
Thanks for having me.
Well, if you want more of the action, be sure to scan the QR code below to stay up to date with all the Yahoo Finance action, as well as keeping track of the latest and greatest market-moving stories. Stick around. More market domination coming right up.
Biden administration is reducing its CHIPS Act grant to Intel from $8.5 billion to $8 billion. The change takes into account a $3 billion contract that Intel has tentatively acquired to produce chips for the U.S. military. This all coming against the backdrop of the Biden administration dispersing CHIPS Act funding before former President Donald Trump takes office. He's been a vocal critic of the CHIPS Act, of course. For more, we're bringing in Christopher Miller, author of Chip War, The Fight for the World's Most Critical Technology, and professor at the Tufts University Fletcher School. Chris, it's good to see you again. So let's talk about Intel first of all. And, you know, Intel sort of, which has been struggling to some extent. Does the weakness of Intel speak more broadly to the maybe uncertain footing of this attempt to reshore the U.S. chip industry?
Well, I think Intel has been pretty clear that they're delaying some of their manufacturing projects globally. In Germany, for example, they've really substantially pushed back project plans. I think in other parts of the chip industry, you've seen pretty rapid efforts to bring new capacity online. In Arizona, for example, the Taiwan semiconductor manufacturing company has just announced that it's got its manufacturing processes at the same level as their primary facilities in Taiwan. So it's a mixed picture, I think, looking across the industry, but there's certainly a whole lot of investment underway to bring new chip making capacity online in the United States.
So, Chris, with the incoming second Trump administration, would you expect to see any kind of meaningful changes to the CHIPS Act?
Well, I think it's worth remembering that it was the first Trump administration that devised the concept of trying to incentivize firms to build more in the U.S. The CHIPS Act was first discussed in Congress under the Trump administration. The first investment of TSMC, the Taiwanese company in Arizona, was announced under the first Trump administration. And so I wouldn't be surprised to see some small changes to the program. Specific grants might be amended, but the basic framework of trying to use financial incentives to get more chips made domestically, that's an idea the first Trump administration more or less came up with.
Is it an idea, now we're going into an administration that has talked much more about using tariffs, and there's been much less talk about those types of incentives. What, in your reporting and from what you've seen, is one more effective than the other? Are they more effective in concert? What do you think, how do you think it's going to play out?
I think what we've seen over the past two administrations, both the Biden administration and the first Trump term, is that you got the U.S. government using both tools, tariffs in certain segments of the industry, incentives in others. The Trump administration raised tariffs on imported semiconductors from China. The Biden team doubled the tariff rate from 25 to 50%. I wouldn't be surprised to see even more moves on the tariff front from the Trump administration when the president-elect takes power in January. I think, though, there's many segments of the industry where tariffs alone aren't going to be a viable solution. There's a small number of chips the U.S. imports from China. Those could well be targeted. There's a much larger number of chips the U.S. imports from Taiwan, which is a close economic partner. And many of the leading U.S. tech firms are the companies importing chips from Taiwan. And so it's much harder to imagine those imports being tariffed because it's big, successful, influential U.S. firms that are benefiting from those imports.
And Chris, on export controls, I'm curious, with this new Trump administration, what do you expect to see when it comes to export controls, Chris? And secondly, the point and purpose of those export controls, to stymie, to slow down China from becoming a global AI powerhouse. How bottom line effective are they?
Well, this is another policy tool set that was largely pioneered by the first Trump administration and then continued under the Biden administration. And indeed, there's a lot of discussion in the media that the Biden team might announce one final package of export controls that'll tighten up the rules even further before the administration ends. And I think we've seen Republicans, especially in Congress, all on the Biden team to enforce controls more aggressively, to close loopholes. And I wouldn't be at all surprised to see the Trump administration, when it comes into office, pursue that effort of tightening up those controls. I think it's very difficult to slow down the AI progress of a country that's as big and advanced as China. But when we see news stories about Chinese computer experts smuggling in semiconductors and suitcases into China, I think that gives a lot of people in the U.S. government confidence that they are really causing challenges to China's tech sector. It's not going to stop all progress, but is it helping to slow progress and giving U.S. firms an advantage? I think most people in Washington, regardless of party, regardless of which House of Congress, there's a conventional wisdom, I think, that controls are working. And I think if you look at the impact on China's chip making, as well as the impact on China's AI sector, that conventional wisdom seems right.
If now China is coming from a place of more weakness than they had been in the past, Chris, do you anticipate that they are then going to retaliate in stronger fashion or are more likely to negotiate?
Well, I think China has shown a willingness to retaliate's probably not the right word, because it suggests hitting back second in response to U.S. moves. Whereas I think in reality, what we've seen is a Chinese effort to build strength across the supply chain, generate leverage against the United States, secure access to technologies. And it's China that largely started the chip war that has led the U.S. to respond. And so I think asking when will China retaliate is probably the wrong way to look at the question. The question is, what's the next stage of China's strategy to build its influence in the semiconductor industry? And I think all of the public statements we've heard from Chinese leaders, all the evidence about the substantial subsidies the Chinese government is investing in this space, all of the evidence suggests that China's as committed as ever to building out its own self-sufficient semiconductor supply chain at the expense of not just U.S. firms, but also Japanese and European and Taiwanese and other players. And I think that's the key factor that led to the chip war in the first place. I see no evidence of that changing anytime soon.
Chris, always great to see you and have you on the program. Thanks for joining us.
Thank you.
All right, let's get to some calls of the day now. Morgan Stanley upgrading Robinhood from equal weight to overweight, the note highlighting its benefit from the presidential election. So Robinhood actually hit a 52-week high in today's trade. Morgan Stanley analyst here saying it's one of the biggest beneficiaries of Trump's election win in his coverage universe. Takes the company to overweight, takes his target to a street high of 55, Julie.
Yeah, I thought it was really interesting in the note here to talking about the stuff that we know about, right? The crypto boom that we're seeing right now, that the M&A is opening up in his words, but also that the company is looking to broaden and widen its total addressable market, in part with an acquisition it just made recently of an RIA, a registered investment advisor custody platform. So sort of not just deepening its existing businesses, but also broadening out into a larger suite of financial services.
Yeah, stock has surged this year already, of course, which we've talked about, but Morgan Stanley clearly says the party continues.
It does. All right, let's talk about another party here, Hims and Hers. Those shares are surging today. The rally coming after a report from Hunter Brook Media suggesting that the company could benefit from Trump's pick for Food and Drug Administration Commissioner Marty Makary, of course. What's so fascinating about this? So just to take a step back, Hunter Brook is the media arm of a hedge fund.
Hunter Brook Capital.
Hunter Brook Capital that invests. So it's sort of an associated investigative arm of the hedge fund itself. And recently, Hunter Brook came out with a piece that said short Hims and Hers. Now they're coming out and saying, well, actually, Hunter Brook Capital is now long instead of short. And this is the reason why.
Yeah, I remember us talking about this short when it came out. They were kind of questioning the business practices and its weight loss business. But now, as you said, their bet here is in part that the company can have an important ally in the Trump administration, the nomination of Marty Makary to lead the FDA, because he's an executive at Sesame, which sells compounded GLP-1 drugs online.
Yeah, but the stock has just been whipsawing on these various headlines.
All right, we'll keep an eye on it. Meanwhile, oil prices sliding Monday on a report that a ceasefire between Israel and Lebanon-based Hezbollah may have been reached. Joining us now is Stephen Schork, the Schork Group principal. So, Stephen, always great to see you. We did have those headlines, those reports. Stephen, possible ceasefire between Israel and Hezbollah, its impact on the oil market. Walk us through it. How do you see it?
Yeah, absolutely. It is, and let's hope we do see this, that it is a bearish driver for oil prices. We've seen a bearish environment overall in the market. It's a market that has perplexed me going back to October 2023 with the start of the war with Gaza. And all of that has meant to the disruption of flow of oil out of the Middle East and the extra cost. It has not had any sort of significant impact. We have had a couple of headlines that have pushed oil prices higher over the past 13, 14 months, but nothing has been sustained. So this is clearly a demand side issue with oil. And the issue has and will be, it has been for the last 3 years and will continue to be China. The growth of China, the expected growth of China continues to hit snags, and that continues to put a monkey wrench, as it were, into the bull's best laid plans for higher oil prices. So now we have the ceasefire in Lebanon, and let's hope this expands to a general ceasefire in the Middle East. And clearly, if we take that geopolitical headline out, then all we are now focused is on the demand side. And so we have the supply side fears. If we do ameliorate those, then all we have left is the demand side. And clearly, I think there's a greater risk in oil moving lower from this point than higher.
And it sounds like, Steve, it's Julie here. It sounds like that's because you think China is going to continue to struggle with the demand equation. So as long as that happens, oil could potentially be under pressure.
Absolutely. There's always, and there has been and will be, continued potential growth in China. But at this point, it's been 3 years. We're waiting for it. We're waiting for Godot at this point. So I'll believe it when we see it. And what we want to really focus on, if you're looking at oil prices, look at the spread action. Look at the price on the forward curve of oil. For instance, if we look at the oil price, the average price in the first quarter of 2025 relative to where prices are in the second quarter of 2025, it is a premium. That is, Q1 prices are higher than Q2 prices. This is what's known as a backwardation. But what is really interesting is where this backwardation is trading. Compared to where we were prior to the start of the Gaza war in 2023, the Q25 premium is trading at 83 cents on the dollar to where it was trading 2 Octobers ago. If we go out and look at the premium of Q2 oil over Q3, Q2 is now only trading at around 69 cents on the dollar to where we are trading. So this spread action, when you see backwardations, premiums on the forward curve falling relative to the back end of the curve, this is your clearest telltale that the market is, one, either oversupplied or there's not enough demand. So clearly, the market is telling us this is a demand issue, and it is a bearish picture at this point.
So, Stephen, with Brent just over 73 here, when you're talking to your clients, you tell them that's headed where, near to intermediate term. What do you see?
Well, we're trading ranges right now, and we go through our modeling, probabilistic quantitative modeling. Coming into this, the final quarter of the year, we had Brent prices at between 75 and actually, you know what? I want to be exact for your listeners here. So we came in here at Brent at around $72 a barrel. This was back in September. We finished last week at just over $75 a barrel. I'm coming up, I have a 50% probability that the market will hold, and this is what I'm telling clients and I'm telling you, will hold below $79 between now and the end of the year. And there's a 50-50 chance we'll finish right around $70. So at this point, we came into the quarter at $72. We're within a couple of dollars of that 70-25 is my median range there. So we're looking at a range of a 50% probability of the market holding in between $79 and $63. So my hedging clients, my producer clients, I like them hedging anywhere in the high 70s if Brent gets back above that range, because I do not expect to see significant momentum above that. Conversely, the end user, i.e. your refinery, if you can lock in oil at that 70 or high $60 range, this is an area where you really want to be taking advantage of.
Stephen, I also want to ask you about policy here in the U.S. With the coming Trump administration, where there's some reporting today out of Reuters that says that, one of the priorities, not a surprise, would be lifting the LNG export ban. There's also talk of issuing more drilling permits. What effect does that all do to that supply-demand equation for oil?
Well, in the long run, it's absolutely going to add greater stability to the market. It will give corporate treasurers more confidence in making investments. And for everyone watching and listening, I encourage you to go back and read 2012 DNC platform on Obama's second term. He was embracing an all-inclusive energy policy, a policy that, of course, promoted renewables, but also promoted taking advantage of this country's vast wealth of natural resources, primarily natural gas. So Obama going into his second term was pro. So we're looking at a broader energy portfolio that's going to include a little bit of everything. And that's going to be a walk away from what we've seen where it's been a binary policy, that is to say it's got to be renewables and we have to destroy fossil fuels.
But Steve, it's not necessarily going to be great for oil prices. I mean, it'll be great for drivers. It'll be great for us who are driving, but it's not necessarily going to be great for people who are long-term bulls on oil prices themselves, right?
Oh, absolutely. No, that's a great point, but let's keep in mind that with greater efficiency in the permitting process and lowering the hurdles to invest, you're going to give the corporations, the oil and natural gas corporations, greater confidence to manage their books years now into advance. So yes, while an oil company would love oil to stay at $70, $75 a barrel, they make money there. The consumer, the economy can grow. They don't want oil prices anywhere above $90 or above, because that begins to eat into the demand equation. And that is worse for them down the road, sustained higher oil prices, because what's going to happen is you're going to push people further away from oil. So you want to keep them into a sweet spot. So that said, I do think in the near term, being the first 6 months of the administration, there is a greater risk for the oil companies of lower oil prices that would be, say, Brent down in that $63 to $60 range. And that would put NYMEX WTI below 60 into the $50 range. Not exactly a great scenario, but it's still a scenario that I think the industry will welcome because they're thinking longer term out. And what they want now is what they've always had is a partner in government, regardless if it was Obama in the White House or Bush in the White House, so forth. They always had a White House that they could do business with. This is the first White House in the history of a fossil fuel economy that we've had a White House that has been openly antagonistic to the industry. So this is what I think the industry is looking forward to. So yes, there is some downside risk for the industry, but there's greater upside potential for further growth, further market share over the next several years.
Stephen, always great to see you and have you on the show.
I appreciate it. Looking forward to coming back.
And stick around, much more market domination still to come. Nike's had a rough few years, as we know, but according to our next guest, the company's decision to replace CEO John Donahoe with longtime Nike executive Elliott Hill may signal a major turning point and be a message to investors that the worst is nearly behind it. With just a few minutes left till the closing bell on Wall Street, we're looking at how to play footwear stocks with the Yahoo Finance Playbook. And joining us now is Tom Nikic, Needham Company Managing Director, Equity Research Apparel Footwear. Tom, always good to see you. So you're a fan of Nike, Tom, a fan of Elliott Hill. Why are you a fan of Elliott Hill, Tom? What about his background? What about his experience? And how long, let's say you're a viewer right now, you're invested in Nike. How long do you think before you start seeing his impact on the company and the stock?
Yeah, I think, look, Elliott Hill, obviously, he had a long and illustrious career. Started as an intern at Nike, 35 years ago, roughly speaking. And then he worked his way up the ranks. And I don't think it's a coincidence that, he retired initially in 2020. And then shortly after he retired, the company started to, become a lot more volatile. And, the performance the last couple of years clearly has not been up to, the standards that the market expects from Nike, in a business of their caliber. So I do think that this is a move in the right direction. I think as far as helping employee morale goes, which I think was challenged, I think that's pretty much an instantaneous effect. Based on my conversations with people in the industry, his arrival has been very, very well received out in Beaverton. Some other things will take a little bit longer. Product development obviously is something that has long lead times and long product development cycles. But I do think at least as far as rallying the troops go, it's pretty much an instantaneous benefit.
What is the biggest risk, Tom, or what's the biggest obstacle that he faces? What could go wrong still with Nike, considering, recognizing that the stock has been pretty beat up?
Yeah. I think the biggest obstacle is just that other competitors have up to their game while Nike has been, off their game, right? We've seen the emergence of Hoka and On. Adidas has been doing a lot better lately. You've had competitors in the apparel space like Lululemon doing better. New Balance has been on fire. So, I think there is the risk that by focusing so much on their own direct-to-consumer, they open the door to other brands and to competitors to be much stronger, to have stronger relationships in the wholesale channel, to resonate more strongly with consumers. There could be a risk that the issues that the company has now could take longer to correct than people expect.
Tom, a broader question for you. Trump is moving back into the White House. Tariffs, of course, front and center. How is that going to impact your coverage universe, Tom? I'd imagine clients are asking you about that.
There's a wide range of exposures in my coverage. There's a couple of things to keep in mind. Number one, any revenues that a company generates outside the United States are not affected by this. So if you're a global brand like Nike, for example, that does 60% of your revenue outside of the US, that 60% of revenue is completely isolated from this potential risk. Also, a lot of brands over time have been moving their manufacturing away from China just for the sake of having a more well-diversified supply chain. So, for example, Nike currently, less than 20% of their products are made in China, and a lot of that stays in China. It's made in China for the Chinese market. So there's not as much risk there. If I look at the two ends of the spectrum in my coverage, I think the company that's the most well insulated is On Running, the Swiss sneaker company. They make almost all their shoes in Vietnam, and what they don't make in Vietnam, they make in Indonesia. So they have de minimis risk from tariffs. And the flip side of the coin would be Steve Madden, that currently makes about 80% of their products in China and don't have that really, really big international presence to insulate them. So as far as my coverage is concerned, those are the two ends of the spectrum.
Tom, great to see you. Thanks for joining us.
Thanks for having me.
And while wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it is market domination overtime. Jared Blickery going to join us to get you up to speed on the action from today's session. I'll start with the major averages here. We did see a record close for the Dow, up 440 points or so, almost a full % higher on the session. It seems like there was broad approval being expressed in the market today for the choice of Scott Bessent, the hedge fund manager, as the next Treasury secretary. He's seen as sort of a steady hand who knows the markets. And is focused on growth, as he told the Wall Street Journal. The S&P 500 up by about 1/3% on the day, and the Nasdaq up just about 1/4%. As we talked about earlier, we did see some outperformance both in the equal weight measure of the S&P 500, which I believe also closed at a record today, as well as the Russell 2000 and the S&P 600. So small cap measures doing well in today's session. I'm sure Jared has much more on that and more in today's session.
Finally got that Russell record. Only took 3 years since November. You have to go back to November of 2021. So that was a long time coming. Well, this is the S&P 600, a bit different, but it also captures small caps. It was hitting record highs, I believe, a couple weeks ago. So it broke out first. But let's get to the bond market real quick. We saw a huge drop in the 10-year T-note yield. 14 basis points is really big. That's based off of that Treasury Secretary nomination. By the way, he helped George Soros break the Bank of England way back in the mid-90s. And here we see the U.S. dollar taking a tumble today just a little bit. Are they related? Well, not exactly. But in that same vein, we want to take a look at the sector action. Only energy and tech ended up in the red, and energy down 2.05%. I'm just going to show you real quick a 25-year chart. This was a sector that was almost ready to break out of a multi-decade base, and so there's some maybe friction before that actually happens, but watch for that. That's something a lot of traders have been anticipating. Here is the leaders for today. Home builders, that should be well, I don't know if that's a record high. I don't think they're there quite yet, but up 4%. That's an interest rate play. Also seeing retail, XRT, solar, cannabis. So pretty interesting mix at the top there. Bitcoin, another troublesome day for Bitcoin, down 2%. Still holding, well, 94,000, not quite 100,000, so losing some steam there. And I'm going to leave us with the Nasdaq 100, and we're going to take a look at some of the big guys. Tesla was down 4%, and Nvidia down 4%, but we got Meta, Alphabet, Amazon, Apple, all up more than 1%, Josh.
All right, thank you, Jared. A record day on Wall Street to start this holiday shortened week. The Dow and Russell 2000 hitting new highs on optimism over President-elect Trump's pick for Treasury Secretary. Joining us now is Callie Cox, Ritholtz Wealth Management Chief Market Strategist. Callie, it is good to see you. So another day in the green here, Callie. It's been a very good year for this stock market. Does it continue in 2025, Callie? What are you telling clients?
I think anybody can, bet against, lower prices here. I don't think it's right to fight higher prices. But to be honest, as long as the economy stays in this, moderate growth mode, then I think we'll be okay. And that's oversimplifying it a little bit. But right now, if you think about it, corporate earnings are growing. The job market is fine, albeit it's slowed a little bit. And it seems like policy might be swinging in our favor, or at least that's what markets are telling us. So with these trends in place, I think it's really hard to fight the stock market right now.
What are some things you're looking at in terms of seasonality here as we go into year-end, Callie?
Well, I was thinking about this morning, Julie. A lot of people on Wall Street talk about performance chasing, or those portfolio managers that are judged on how well their stocks perform every year relative to the S&P 500 or another benchmark. It's becoming crunch time for them. They have to outperform a benchmark that has risen about 25% this year, and a benchmark in which, about 30% of its stocks, only 30% of its stocks have done better than the index. So basically right now, portfolio managers are having a really tough year because their performance is based on, how much better they do than the S&P 500, not necessarily how well the S&P 500 does. So there could be some chasing into year end, some, buying stocks to, push performance a little bit higher in these funds. And, it's more of a almost like a lure on Wall Street, but I do think it comes into account, especially in these years when so many stocks underperform.
Interesting to get your post-election thoughts too, Callie. A lot of moving parts with Trump's policies, taxes, deregulation, tariffs. We were speaking with one strategist earlier in the show who said, frankly, it's impossible to model at this point. He doesn't know the timing, he doesn't know the magnitude. But how are you thinking about it?
I agree. I think the smartest thing to say right now is I don't know. But that's not usually a satisfactory answer. So I like breaking things down into what we know and what we don't. Right now, a lot of policies have been floated. We've heard a lot about tariffs. We've heard a lot about deregulation, potentially lower tax rates. And, I think markets are focusing a lot more on the rewards than the risks right now. Of course, today we saw a strong rally in regional banks, and that's one of the reasons why small caps hit a record high today, which, by the way, is a good thing. Don't fight momentum. But, I think a lot of this momentum recently has been on the hope for policy maybe, disentangling or maybe loosening up some of the reins on certain sectors. And I'm not sure that we've, quite considered what the risks could be, especially with inflation being such a recent worry for this economy.
So talk to us through those risks then, Callie. And, momentum works until it doesn't, I guess. So what are you watching most closely to see what could be a potential risk here?
Well, I think the biggest risk is the economy overheating. And what I mean by that is, more uncontrolled inflation coming back into play. I'm not saying this is going to happen, but when you have a new administration talking about lower tax rates, deregulation, when the economy is already growing at a pretty manageable rate, you have to worry a little bit about what prices can do, especially in an environment where Americans are quite sensitive to prices. I mean, tariffs obviously are that one-time increase in price, and there are a lot of different angles to think about on the back of that. But it all comes down to this for me. Prices are clearly the concern, the economic concern for a lot of Americans, and I'm not sure many of these policies solve those problems in price that so many people pointed to during the election.
Talk about valuation for the market, Callie. I mean, I know valuation's not great timing tools, but as a strategist, how are you thinking about it?
We get a lot of questions about it, so I talk a lot about valuation with our clients. The main thing I say is that you can't judge a market specifically on valuation alone. In a vacuum, valuation tells you where markets are trading relative to earnings, but those high valuations could continue, or valuations could come crashing back down to earth. We just don't really know. So right now, the biggest thing I'm saying to our clients is to, focus on valuations of certain sectors. When you strip tech out of the S&P 500, you see that valuations are a little more manageable, a little more easy to digest. But if you really want to protect your portfolio and you're worried about valuations, maybe rotate some money out of the higher valued stocks in your portfolio, because there are a lot of opportunities still on this market. I mean, small caps come to mind, hitting their first record high since the beginning of the bull market. So there are places to look if you're worried about valuations. I wouldn't be too worried about them right now, though.
Callie, give us some other ideas of where people could be looking, whether they're high valuations or not, where people should be looking in this market.
Well, I go back to rotating out of tech, Julie, understanding that tech has had a strong run up to this point, but, knowing that there are other parts of the market that just haven't caught up as well, that are, have done well in these past few months. I'm looking at rate sensitive sectors as long as interest rates come down. We're seeing a lot of value in small and mid caps as well, because the story for most of this year has been those large cap tech stocks. So, focusing on real estate, for example, consumer discretionary stocks, for example, I think are really interesting, especially if the economy stays afloat.
Callie, good to see you. Thanks a lot. Treasury Secretary nominee Scott Bessent gets positive early reviews from Wall Street, but he is facing tricky tasks in the months ahead. Yahoo Finance's Washington correspondent Ben Worschel joins us now with more. And we've gotten a little bit of insight from some articles in the Wall Street Journal and elsewhere as to what he's prioritizing, but what could be some of his challenges, Ben?
For sure, Julie. So he's definitely clearly in a kind of honeymoon phase right now. So what I'm looking at for a story tomorrow is kind of the ways the honeymoon ends. And I have 4 for you, including the taxes one, which is his top priority. A couple other issues that are kind of looming for him that he'll have a tricky time with in the weeks and months ahead. One is tariffs. That's the big one. We talk about it all the time. Scott Bessent has kind of aligned himself with Trump on tariff, but with some key caveats. He's talked about it. Tariffs, but for strategic industries, tariffs, but rolled out gradually. Trump notably has kind of blown past any of those caveats. And he also has another figure of the administration, Howard Lutnick, who's kind of all in on tariffs as well. So there's clearly going to be a debate in the administration, and the markets like these caveats that Bessent has put forward. But the question is kind of who wins that debate next year. A couple others to flag. One is a pushback from the left, specifically on the Federal Reserve. Elizabeth Warren is going to be likely to be a big Bessent antagonist over the coming year. And in her statement on it, she zeroed in on the Fed specifically this idea that Bessent has of a shadow Fed chair, basically appointing someone soon to make Jerome Powell a lame duck. And Warren, even though Bessent has reportedly kind of backed away from the idea behind closed doors, Warren is focusing on that and is clearly going to be questioning on that and bringing up the kind of questions of Fed independence, which markets are a little less fan of. And then the other one is unrest from the right. This was a really laborious process for Bessent. He was the front runner at the beginning. He kind of saw his stock fall and then rise again. And in that time, he kind of of earned critics on the right side there. Elon Musk notably called him a business as usual candidate, which is not a compliment, which he was not a fan of. And there's a lot of focus here on the fact that he used to work for George Soros, and he contributed to Hillary Clinton a long time ago. So there's that. And then the last one is the tax one you mentioned, which is what he said his top priority is. And there's a lot of questions about whether he can deliver these promises. Trump has talked about 12 different tax cuts he wants to have happen. Bessent's going to be charged with doing it. But with a $36 trillion federal deficit, that's going to be tricky.
I'm curious, Ben, despite that, there was that criticism from Senator Elizabeth Warren, as you pointed out, but is the expectation here that he should get through this confirmation?
Yeah. For sure, yeah. The sense is that he'll sail through the confirmation, at least right now, partly because of this positive reaction to it. Elizabeth Warren, notably in her statement, didn't say she was going to vote against him. She's going to meet with him and then decide. But among the kind of spectrum of Trump cabinet appointees, this one is likely to kind of get through quickly, as opposed to other figures like Robert Kennedy, which will be a big fight over the years ahead. But Bessent will be easier.
If I look back on the first Trump term, Ben, the Treasury Secretary, Steven Mnuchin, was one of the steadiest hands, right, within that cabinet, both in terms of policymaking, but also in terms of his relationship with Trump. One of the folks who did not come away with a tell-all memoir, whatever it is. Right. So what lessons do you think Bessent could sort of take away from the Mnuchin experience?
Yeah, I mean, I think with Trump's record, what he shows you is that the area kind of interestingly he's most careful on and a little bit wary of kind of going too far is the economy. On these other appointees, Attorney General, Health and Human Services, he's willing to kind of roll the dice. But I think the Bessent choice and the lesson he might take along with the Mnuchin choice is that he wants to kind of get a steady hand in there and he's willing to listen to them. Mnuchin was one of the few cabinet members that survived all 4 years and was there all the way to the end. And Yellen did the same thing under Biden. So this has been as you noted, an area of relative stability, even in sort of Trump's world where things can happen a lot quickly. So I think he'll have a close ear with Trump. The question is whether he can get his policies through.
Yeah, I'm also curious, Ben, just about the different personalities and characters involved in all this. Because as you point out, you got Scott Bessent, and now he's going to have to, if confirmed, he works in the same administration as Howard Lutnick, who was campaigning for Bessent's job and seemed to have the backing of Elon Musk. How does it all possibly shake out, do you think?
I think it becomes what Trump has shown is he likes, at least on the economy, a kind of team of rivals who offer him different views. And then Trump will be the one who decides on tariffs. He'll have Lutnick, as you noted, on one side, especially on these things. Lutnick, who's talked about how he likes the 1890s and when tariffs were the thing and before we had the income tax. And we have Bessent, who's offered a much more measured thing. The question is whether Trump, who, by the way, has talked also about the 1890s as a model for him, who he ends up listening to in the end, and can Bessent sort of get in there and say, if you do this, the markets are going to really dislike it, which can be a convincing argument for Trump for sure.
Ben, always great to see you. Thank you for joining us.
Good to see you.
Well, if you want more on the action, be sure to scan the QR code below to stay up to date with all the Yahoo Finance content, as well as the latest and greatest market-moving stories. Stick around, more market domination overtime coming right up.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Potential ripple effects of President-elect Trump's promised China tariffs hanging overhead as a dark cloud for some industries. Former Gap and J.Crew CEO Mickey Drexler are telling Yahoo Finance's Opening Bid podcast about risks from Trump's tariffs.
I mean, so many goods, parts of cars, everything else are made in China. And it will not be good for the consumer or for us retailers.
With Trump looking to create a new era of U.S. trade, we're sorting out companies caught in the crossfire with Strategy Risks founder and CEO IXIC Stonefish. IXIC, thank you for being here. There's a lot of companies, obviously, that still make a lot of things outside of the U.S. And what we've heard from Trump, 60% tariffs on China specifically, 10% for everybody else. So when we're looking at who's most affected, how do we kind of suss it out?
This is a massive, massive implications for a whole range of companies that are heavily exposed to China, and companies, as we know, are scrambling. And the real question is how much of their manufacturing is dependent on China, and then how essential is the part of their manufacturing dependent on China to their supply chains.
And so, IXIC, so let's say you're some consumer-oriented American company. You're relying on China, you're maybe a bit concerned. What's your move here? What is your response?
Move is to better price out your exposure to China, run the numbers very, very carefully, and decide, do I want to go against what my customers want and what my US government wants and really double down on China, or do I want to really seek to diversify away from a China that's becoming less friendly to American businesses, but also becoming much more of a regulatory hotspot?
IXIC, why haven't more companies diversified already? We went through this once before. The global economy is becoming sort of less of a duopoly over time. What are they waiting for?
That's a great question. So we track this very closely, and we expect at some point the other shoe to drop, but it really hasn't yet. And we think that's in part because of the strength still of the domestic Chinese market, in part because of the idea that companies think they can manufacture in China for China, in part because companies think, hey, this is going to change, and that the last 10 years are just going to disappear. And then in part because companies are afraid of reprisal and afraid of what's going to happen to their people and their supplies in Beijing if they move too actively.
Well, how much have things changed? I mean, when you look at the number of U.S. multinationals that are manufacturing in China, whether it's for export or domestic there, how's the shift been over time?
So one of the problems with quantifying the exposure is supply chain data is very poor, and companies will often say, oh, these are the number of factories we have in China, but we're talking to a retail CEO who said, well, we had, say, 100 factories and only 4 were in China, but the 4 did 60% of our business. And so it's really hard to quantify based on the numbers. We've seen some high-profile companies like Steve Madden, like Stellantis, which makes Jeeps, say that they're going to reduce their China exposure, but still for the majors, the Apples and the Microsofts of the world and the Boeings, haven't moved all that much.
Let's say, IXIC, Trump really means it, and we really do see tariffs of 60% on all Chinese goods. You would expect Beijing to respond and react how?
Great question. Beijing likes to respond asymmetrically, and so they will bluster, but they'll also punish certain American companies, and possibly even companies that are very close to Trump or companies that hate Trump and have been active against them. They like to do it in a way that there's plausible deniability. There's a famous case about 5 years ago with a South Korean company that had a link to the South Korean military, and Beijing responded very, very harshly against them, even though the link was fairly tenuous. So we could expect to see something like that and keep American companies on their toes.
It's interesting when you look at the goals of these tariffs or export controls or what have you, it seems to be twofold. One is to get Americans a better deal on stuff, right? And also to sort of advantage American industries against China or whatever countries you may have. Did it work well the first time, and will it work with a higher magnitude of tariffs?
It's a great question. So there's Trump's goals and there's his people's goals. And Trump's goals are tariffs for tariff's sake, because tariffs are good for America, because they bring jobs back. All that's debatable, but that's Trump's views. A lot of the people around him do honestly seem to feel that the US and China are preparing for war, and that we need to reduce the economic exposure to China because the countries are too coupled with each other, which will make war fighting far more disastrous.
Wow.
Isaac, we've been talking a lot today about Trump's pick for Treasury Secretary, Scott Bessent. What do we know about how Mr. Bessent thinks about China?
We don't know very much. He had a Fox News op-ed recently where he called the Chinese regime despotic, which is stronger language than I think any Treasury Secretary has used in the past several decades. And Soros has long been quite hawkish on China.
Would you look broadly at Trump's cabinet? I mean, whether it's Stefanik or Waltz or Rubio, and say, I mean, what does that tell you about Trump's position and strategy toward China? How it could very much differ from Biden's?
He is a lot more aggressive on the picks this time than in 2016. It's really a continuity from where Biden was. Rubio especially is very respected on both sides, and I almost hate to say that out loud because I don't want to get him in trouble, but he is bipartisan, and we really like the work that he does and the way that he focuses on the Chinese Communist Party and also the way that he differentiates that from the Chinese people. We think that's very important. Some of his other picks are, as we all know, less serious, but certainly the folks in the national security realm are really saying and seemingly doing a lot of the right things as it comes to China.
Isaac, I want to go back to the war comment you made a few moments ago. This administration, then, the picks that he has made, does it make war more likely with an adversary like China? Or is it sort of make it less likely if you're preparing for potential that you can avoid it?
It's the $10 trillion question. Yeah. So Trump is less likely to go to war than Harris. Trump is more of an isolationist and more likely to make a deal with Beijing over Taiwan. Everyone that we've just mentioned in the cabinet would almost certainly push very hard against that. And the question probably will be if Beijing, say, tries to take Taiwan or launches missiles over the Taiwan Strait, what is his mood? Who has talked to him last? How does he want to respond in that day? And it's going to be very much on his personality, on his feeling at that time.
Isaac, always great to see you in studio. Appreciate it.
Thank you.
Time now for What to Watch Tuesday, November 26th. We're going to be getting some fresh economic data, starting with November consumer confidence. The estimate stands at 113. That's a nice bump from October, which stood at 108.7. Saw the biggest one-month gain since March 2021. Next up, new home sales for October. Analysts expecting a total of 720,000, down from September's 738,000. This data coming after last week's report showed existing home sales grew 3.4% in October 2024. It was the first year-over-year gain since July 2021.
Also, minutes from the Federal Reserve meeting earlier this month. Those are due Tuesday also. Policymakers voted to cut interest rates by 25 basis points following an initial 50 basis point reduction in September. And investors will be looking for any clues on whether the pace of rate cuts could drop from here. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere on the other side of the break. It's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers,
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was a record day on Wall Street with the Dow closing at a new all-time high and the Russell 2000 nearing the finish line, hitting an intraday high, but missed a closing record by less than a point. The sentiment boosted by President-elect Trump's pick for Treasury Secretary. We've got the trading day takeaways ahead. Plus, we're just days away now from Thanksgiving, and Americans can expect to spend less putting their holiday meal together, but there could be concerns on the horizon for your grocery bill. What areas are seeing prices rise? That's coming up. And the big business of paying football players, what to know about name, image, and likeness deals with Yahoo Finance Sports Report host Joe Pompliano. Over the past decade, food prices have increased 3.2% per year as consumers grapple with historic costs for Thanksgiving staples. Our next guest is there to help shoppers get the most bang for their buck. And joining us now is Robin Wenzel, Wells Fargo Agri-Food Institute Group Head. Robin, it is good to see you. So plenty of viewers, listen, Robin, they're getting together for Thanksgiving. How much is this meal going to cost this year, Robin, versus last year? Are we going to see some relief?
A little bit, Josh, but I should probably break it down for you a little bit. This year, we took a look at name brands versus store brands to try to guide consumers around where they can find the best opportunity to shop. And as you said, we continue to see prices going up. But what was interesting to us this year was that the name brand category, this is for a menu to feed 10 people with a turkey and various sides, we actually saw that come down about 0.5% year over year. You're still going to save with that store brand. As you can see, you'll save about $17 over going with the name brand menu. But we do see the pricing gap start to narrow between the two categories.
Why is it coming down at all, Robin? What explains that?
A lot of the name brand companies, when coming out of COVID, when they were having to deal with the higher prices, so labor struggles, supply chain struggles, you know, they may have overshot a little bit with the pricing, and they're starting to scale back to meet the consumers where they are. So we're seeing many of those categories start to come down year over year.
And Robin, so if you're watching this right now and you're shopping around, what's any smart tactics, strategies viewers should deploy here, Robin, as they get ready to make this meal?
Absolutely, and I think part of it goes back down to that pricing gap narrowing between the name and store brands. So I think consumers have some flexibility this year. Retailers are really working hard to get people into the stores. The name brands and the store brands are buying for those consumers. So if we look at the turkey, let's start with the star of the show, the turkey. So 75% of turkeys are name brand turkeys that are sold every single year. As we approach Thanksgiving, we're going to see pricing come down in both categories. But right now, we actually see that the difference is very small. So although the store brand may cost less, it's really just a couple of dollars difference at the end of the day. Where we see things shift a little bit, where we want to really recommend the store brands, is maybe when you get into the bakery. So people like convenience, they like to buy their dinner rolls already prepared. We are seeing the store brand category be a better option for consumers. But I'll say on the other end of the bakery aisle, when we look at the pies, and specifically pumpkin pies, which are very seasonal. About 10% of all pumpkin pies are sold in the weeks leading up to Thanksgiving. We really see it's almost an even split between name and store brands. So go with whatever your preference may be.
How do prices this year, Robin, compare? We talked about it versus last year. I'm curious, would they compare, pre-COVID, 2019?
You know, that's a great question. We have seen pricing go up year over year. We really saw it go up quite a bit during COVID, but they are starting to come back down. So I don't have the data going back all of those years. I would say that consumers, though, are still feeling the pinch and the sting of high prices.
Generally, Robin, let's get just beyond Thanksgiving meal. As you look ahead at 2025, what does food inflation look like?
I wish I had the crystal ball. What I will say is that as we look at this year's harvest, right, because we're talking about agriculture at the end of the day, we had record crops for soybean, wheat, and corn. These are all part of the input costs, especially with the proteins. They go into the feed. So we should see some stabilization potentially with feed costs going down. That's going to help out a lot of these producers. it was a good year for a lot of vegetables and fresh produce. We get most of our produce from California, Arizona, Mexico. They had good growing conditions, good access to water. So we'll see, again, some prices look good. If we're talking about pumpkins, canned pumpkins for next year, it was a great pumpkin crop this year. So we'll see that going into next year's canned goods.
What about the star of the show, Robin? Any idea of where turkey prices are headed?
I think as people shop around and as we approach the holiday date, we're going to see prices continuing to come down. Turkey really ends up in one of two places, either in the deli for your sandwiches and sliced meats or on your Thanksgiving table. So this is the time of year where they're really pushing the turkey. And it comes at a time, too, where people are looking for other options other than turkey. So you're going to see some good values, not only with the turkey, but if ham is what you want on your Thanksgiving table or chicken, you're going to see some good value out there.
Final question, Robin. My producers are very interested. Egg prices, eggflation. Any thoughts there, Robin? Where could they be headed over the next 12 months?
Yeah, it's something that is highly impacted by bird flu, as we've seen. So when we see bird flu and the laying hens all have to be culled, we see the supply and demand, and we see those prices go up. So I think it's difficult to assess 12 months out. I would say right now, get ready to experience some higher egg prices.
Robin, great to see you and enjoy the holidays.
You do as well. Thanks for having me.
Stick around, more Ask for a Trend still to come. When the NCAA decided to allow student athletes to profit off their name, image, and likeness back in 2021, it was apparent the shift would transform college sports. But almost 4 years later, the impact of that decision is still rocking programs on a weekly basis. And the latest example, five-star high school quarterback prospect Bryce Underwood shocking the college football world by announcing he's decommitting from LSU in order to join Michigan. One of the possible reasons, a $10.5 million NIL deal. Join me now to talk about all this is Joe Pompliano, Yahoo Finance Sports Report host. Joe, always good to have you on the show. So let's talk about this, Joe. Bryce Underwood making headlines, switching from LSU to Michigan, and one possible reason, this big NIL deal. What do you make of it?
It's sort of a middle finger to the NCAA when you really think about it, right? The NCAA implemented these rules several years ago, and the idea behind it was simple. They wanted to allow college athletes to monetize their name, image, and likeness through endorsement deals. But what we've seen over the last several years is that it's entirely different than what it was initially supposed to be. And Michigan and Bryce Underwood are a perfect example of that. If you think about a $10.5 million NIL deal, now this is spread out over 3 to 4 years, depending on how long he stays, so it's a couple $1 million a year. But it's the biggest deal that we've seen in the NIL space yet, and we're going to see a lot more of it, because what we know is that these schools use football and all of their athletic programs as the front door to the university. So if you think about Michigan, they won the national championship last year, and then this past fall semester, they saw more than 100,000 applicants apply to the school through undergraduate and transfer programs. Now, that was a 10% jump compared to the year previous and a 50% jump compared to 2 years ago. So there is nothing better from a marketing perspective than high-level, big-time college football games. And if you have to be able to pay the players to be able to get into those games, then you're going to do it. And Michigan is proving that to be the case.
Joe, let's stick to all things college, because right now all the money you got coming from boosters. There could be change on the horizon, right? Let's check out a clip from your discussion with Yahoo Sports college football reporter Ross Dellinger.
For the last 3 years, around 80% of the compensation athletes are getting are coming from boosters. Those numbers are provided by some platforms that work in the space, and I think they're pretty accurate. And so now there's a settlement, right, of an antitrust case. And the settlement will provide the opportunity for schools to pay athletes directly instead of the money coming from boosters. So the idea is to move the money coming from boosters under the school umbrella operation and let them pay share revenue that they get from TV and ticket sales and sponsorships to athlete. They get a cut of the revenue.
So the idea, Joe, walk us through this. Money from boosters instead money from the schools?
Yeah, so like I said before, the idea was that you would be doing these endorsement deals to get marketing money based on your name, image, and likeness. But what we found out is that the boosters are the ones actually paying the money. With the case of Bryce Underwood, it was Larry Ellison and his wife that donated the lion's share of that $10.5 million payment. It's not being raised through endorsement deals with a company like Nike. So what is happening now is the NCAA has settled a lawsuit where they're going to be allowing schools to directly pay athletes, essentially revenue sharing like you would see at the professional level. And what we know is so far that roughly $20 million in year one is going to be eligible to be shared. So the smaller schools probably won't get to that number. Maybe they do 5 million or 10 million or potentially 15 million. But the bigger schools like an Alabama, a Michigan, and Ohio State are going to be paying out $20 million annually to their athletes. Now, most of this money, almost all of it, is going to go to the football team. And then they're going to go back to using boosters to fund the non-revenue generating sports, sometimes a women's basketball program, a gymnastics program, a swimming program, things like that. And what we're finding is that some of these deals might still exist, right? The boosters are always going to give money, but the majority of the money should be coming from the schools, potentially evening the playing field a little bit more than we see today.
And Joe, finally, Formula One. Big race over the weekend, of course, in Vegas. How huge was it, Joe? Break it down for us.
It was a massive race. If you think about Formula One and what they've tried to do in Vegas is they've tried to create a new flagship race, specifically here in the United States. I mean, you already have Miami and you have Austin, and now you have this third one in Las Vegas. Now, a lot of Americans were upset at first because I think around 50% of television watchers are on the East Coast, and the race started at 1 a.m. But what we've seen is that this event has now been massive in both its first 2 years. Over 300,000 people attended both years of the race, and the first year had an economic impact of $1.5 billion, and something million of that came from tourists and $77 million in net new taxes. So this has been really great for the city of Las Vegas, and it's been even better for Formula One as they're able to create this new flagship race that didn't previously exist.
What about, Joe, Formula One expanding the grid to include GM? What do you make of that?
I think it's great. Look, anytime you can add a new team to a new sport, same thing as expansion in the NFL or NBA or another league like that, I think it's additive to everyone else. Now, the thing they've all been grappling over the last number of years is the fact that that team has to provide enough value for them to share in the revenue of the media rights. So if you're a team like a Mercedes or a Ferrari or a Red Bull, to give up a portion, a share of your media rights, you have to have certainty that that new team is going to add value. So Formula One obviously got that certainty over the last number of weeks. They've decided to add that team. They're going to be starting here the next few years. I think it's probably going to take them a few years to get up to speed, considering Formula One is such a technically challenging sport. But more teams, the merrier for me. This is going to grow the sport, specifically here in America with a brand like Cadillac.
Do you see that as also just good news for GM, Joe?
Yeah, I think so. Look, all these teams are using Formula One as a marketing platform. I mean, Ferrari, they literally do no marketing outside of Formula One. Their Formula One team is a marketing platform for the business. Now, they only sell 13,000 cars compared to a Mercedes that sells over 2 million cars annually. But I think anytime you can get your name and your brand in front of hundreds of millions of people, it's great, right? This Formula One, the easiest way to think about it is that there's like 75 million people that watch every single race, and there's 25 races a year. So it's nearly a Super Bowl, but rather than once a year, it's 25 times a year. And you're not buying a commercial, you're buying a team. So that team is on the screen, it's talked about in the media and everything else, and it's going to be hugely beneficial to GM's bottom line, is my guess.
Joe, always great to have you on the show. Thanks for joining. New episodes of Yahoo Finance Sports Report return next Thursday. That's December 5th across all podcast platforms. And stick around, much more Asking for a Trend right on the other side.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Kohl's Corporation announcing that Chief Executive Officer Tom Kingsbury is planning to step down effective January 15th, 2025. And the Kohl's board is appointing current Michaels CEO Ashley Buchanan. And joining us now is Yahoo Finance senior reporter Brooke DePalma. Brooke.
Yeah, good afternoon. Certainly breaking news in after-hours trading. Kohl's shares under pressure following this announcement. We do know that Tom Kingsbury, the current CEO of Kohl's, did join the board back in 2021, then stepped in as interim CEO in 2022. And we now know that he will stay on in an advisory role to the new CEO, Ashley Buchanan, until he retires in May of 2025. Now, we did know when Tom took the helm that he was planning on leaving the company in May 2025. Also important to note here that Tom does hold a seat on the board. The board will be eliminating that one seat following his step down and ultimate departure. And here's what we know about retail veteran Ashley Buchanan. He is currently the CEO of the Michaels Company. Prior to becoming the CEO in 2020, he was at Walmart for 13 years. His most recent position there was as executive vice president and chief merchant of the U.S. e-commerce business for Walmart. We also know that Ashley has a longing for the physical brick and mortar retailer. He also does serve on the board of Macy's. We also know that he was very invested in that brick and mortar retail strategy and that omni-channel approach to things. He introduced new technology within the Michaels stores like supply chain pricing, automated back room, as well as a self-checkout. If you now go into Michaels, most of those locations do have a self-checkout. And when I spoke to him most recently, he was very excited about this opportunity to create a true omni-channel approach. We know that Michaels now has more in-store experiences. They actually have birthday parties now. And I think that, ultimately this is what Kohl's is looking for. We know that earnings are set to come out tomorrow morning. Not a pretty picture as far as Wall Street's expectations
net sales
go.
expected to drop nearly 5%, Brooke. So to your point, and that stock's been under real pressure. We're down more than 30% this year.
Yeah, really leaning into that department store saga that we're seeing overall.
All right, thank you, Brooke. For our chart of the day, we're looking at the role of big tech keeping profitability healthy for the S&P 500. And Yahoo Finance Julie Hyman joins me now with a closer look. Julie.
Hey, Josh. Well, this coming to us courtesy of Vinod Krishna, Barclays head of U.S. equity strategy, who is out with a new target for the year-end 2025 for the S&P 500 of 6,600. And he says large cap tech earnings are going to help contribute to that, just as they have been. We've been talking about the broadening picture, right? And he says we are going to see broadening, but large cap tech is still going to be king in terms of earnings growth. So here are the estimates of what we're seeing here, both for what we've already seen reported for the third quarter of this year. This green line is large cap tech earnings per share growth year over year. The white one is the rest of the S&P 500, the Mag 7. So that amount is increasing, but it's still not going to be bigger than the growth that will be achieved that's expected for large cap tech from Wall Street here. It will only change if you go out to the first quarter of 2026. So basically he's saying it is a delayed effect. And here's what he told us earlier today.
The market is on a consistent basis underestimating the earnings power of tech, especially big tech. At the same time, it is systematically overestimating the earnings power of the rest of S&P outside of tech, right? And so this quarter is a great example of that.
So indeed, this quarter that we just saw, where you saw the big growth here of 30%, whereas he said 19% growth is what was expected for the Magnificent Seven. So he says that is still going to continue to be a growth engine, even as, yes, the broadening will still happen, because he says even though the expectations are a little more muted for the rest of the S&P 500, those companies should still beat expectations, and we should still see the stocks increase here. Josh, of course, a big caveat that you and I talked to him about is that there are a lot of policy uncertainties that are going to be coming from the Trump White House. And so we'll just have to wait and see how those play out.
Yeah, I like when we asked him that, Julie, during the show. We asked him, listen, I mean, you have so many cross currents. It's taxes and tariffs and deregulation. And we asked him, how do you actually sort of just try to sift through that as a market strategist? And he told us, very honestly, it is impossible to model. He said, I don't know the timing and I don't know the magnitude.
So you just have to kind of plot out all those scenarios and then wait and see what happens.
That's it. Julie, thank you. Appreciate it. Let's take a look at what's trending after hours now. Check out shares of Zoom Video Communication, and they are edging lower. After hours, the company reporting third quarter earnings earlier today, beating on the top and bottom lines with revenue coming in at $1.18 billion. Zoom also boosting its revenue guidance for the full year. That guidance also beating analyst estimates. Agilent shares fall after reporting fourth quarter earnings. That company beating adjusted earnings per share estimates, those coming in at 1.46. Net revenue coming in at $1.7 billion, also topping estimates, but the company's first quarter forecast coming in light. Adjusted earnings per share coming in between 125 and 128. Analysts had been estimating 137. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.